So today I thought I'd talk about a stock that is down 23% since Friday after it reported earnings and is having a really tough time, and see if that stock is a buying opportunity. And I'll tell you what else is having a tough time at the moment. The market today, we've had Monday off and then we've come back on Tuesday, and wow, the US market has just got a slap around the face and it's been a painful day out there. So there's a few other stocks I could potentially talk about, but today I thought I'd talk about this one in particular because it's a stock I used to own, and it would be good to see if there's potentially a price that I could potentially buy this again after the drop. So I hope you enjoy it. Let's get started. So I've actually been asked about this stock quite a bit in the comment section. You can see here from Gody, a legend of the channel, been around for a long time. He was even asking for my opinion, and I've seen it on the Discord, a few people asking for my opinion. So today I thought we'd take a look at Dropbox after its big drop off earnings. So if we do have a look at Dropbox, it's now currently $25, down 22% or 23% on Friday, and it is an 8 billion company, so a bit of a mid-sized position. You can see it trades at 19 times earnings, so it's a profitable company, and the stock hasn't really done much since it IPO'd. If you actually go from where it IPO'd in March 2018, the stock is basically break even, or could you say even down 15% since its IPO, so it's not really done much. These times where if you caught the bottom and you went all the way up to the top, you could have potentially made money on it, but it's not been a great performer in the stock. And I actually used to own Dropbox. Some of you guys might remember I owned Dropbox. From the dip on the IPO, I held it, it ran up a bit and I sold my shares. And if you actually look at this post here, I had to go see actually when I used to own it. And I went back on the Discord to have a look on when I used to own it. And you can see here that I posted this around about the back end of 2022, which was actually a really tough year in the stock market. But I actually sold off my Dropbox position. It was a bit of a small position. I was kind of not really seeing anything to make me buy more, and it just doesn't seem like it was developing into what I thought it would. So I did decide to sell the position off for a 30% profit. And actually on the same day, I actually sold a 10% of my Celsius position, if you look here, for around a 55% profit, which isn't too bad at all. So to say that 2022 was my worst year in investing, and that's where I had four or five pretty bad picks that stung my portfolio, even during such a bad year, it's crazy to see that we're still Dropbox that we were selling for 30% profit and Celsius for 55% profit, which makes you laugh when you look back on it and you'd say that was such a tough year, but yet these stocks were still getting sold for profit. It's funny what you call relatively terms a bad year, isn't it? But yeah, I did sell my position for 30% profit, which is okay. It didn't develop into what I was hoping for. Obviously, when I buy a stock, I want to get 100% return over the next 5 years, and it did do okay, but it definitely didn't develop into that 5-year hold and that 100% return, even though we did make money on it. And it's funny that I always forget to mention Dropbox because we've had so many winners on the channel that it's one that you just kind of brush under the carpet. But if I was down 30%, I would hear about it nearly every single day, which is quite funny to say. But Dropbox, you can see here, they say it's a place where you can collaborate seamlessly and deliver work faster from anywhere with Dropbox securely to store your content, edit PDFs, share videos, sign documents, and track file engagement. Now I've got to say, they didn't make a acquisition of a signing document like DocuSign. What it was actually called, it was something sign. They made it a while ago, which you can actually see here. I've not actually seen them mention that much recently, so I don't know if that hasn't really developed into what they were hoping for when they signed it, but it is a kind of cloud sharing platform. Now also, when I think about cloud sharing, I always think this is a competitive market, and if you actually look here, they have 2.37% of the market, which doesn't sound a lot. And you do look at some of the players in here with Slack, Google Drive, Microsoft Office, for example. There's some big players in this space, but realistically, when you do look at the space, it's a big area. It's 67.9 billion in 2021, and into 2030, it was supposed to be growing at a CAGR of 24%. So when you have a market this big and growing this big, even though it's a competitive market, you would hope if they can maybe hold their own against Microsoft and Google and take an okay share of the market, then they could still be successful. The problem is when I look at Dropbox recent earnings, it looks like their competition in this market is starting to lose steam to a lot of the other providers. So they used to be, in my opinion, a decent provider, but I look at the company now and I do think the competition is starting to eat away at them. Now, even though the recent earnings were okay, if you look at the EPS point of view, it was a decent beat. Even if you look at the revenue growth, it was up 6% and it beat by 3.32 million. Is that when I look at the longer term growth, And the suggestion that they helped on this guidance, they actually left on the conference call. They actually left it to the conference call to give the guidance. And then when you look at the guidance were just weaker than the year before, which is not what you want to see. And you can see that they came off that year growth of 6%. This year's guidance is only 2%, and the year after, 2025, is 2.8%. And the average EPS is go from $2.05 from $1.68, which is still an improvement, but this is rapidly slowing down. And when you look at the growth overall compared to when I first bought it, they were holding their own, Dropbox. You can see the company was growing 20+%. Now the growth slowed to 18%, which I think is still good, 13%, which I think is still okay. And then we started to hit the single digit in 2022, but now you can see the growth is now down at 6%. And as the guidance suggests, we're going to go down to 2%. So when I look at this competitive area, hey, if you have a good platform, which I think Dropbox is, and they're able to innovate themselves enough and keep the market share, which is a big market, they can do really well. My problem is at the moment is that the suggestion to me is they're losing out to the competition out here because the growth is slowing. The recent earnings was the lowest that we've seen for a while. Paying users as well is slowing down, and the growth is slowing down. Historically, when we look at the historic growth, it is slowing down, as you can see here, and the guidance suggests it. And that's the worrying thing for me with Dropbox, is that when you're in this trajectory, it looks to me that the competition is beating you, and that's kind of uninvestable for me. Now the other thing as well is like the valuation doesn't look exactly cheap. I saw this at the moment, I thought, well, 19 times earnings, that's not too bad, is it? And then you start looking at the moment and you go, well, 19 times earnings on a forward basis is around about 15 times forward earnings when you look on a forward basis, which isn't amazing. You start comparing that to historically what Dropbox does trade at, and it's normally traded at around about, when it was growing at 20+% or high teen, 29 times earnings. 2022, when it was growing nearly double digit, it was 23 times earnings. So I was looking and thinking, it's not really a discount to what it historically is at. And if you're picking a company at 15, 20 times earnings, you definitely don't want to see this sort of EPS growth and this revenue growth. I don't think that's good enough. Now, a few people say, well, they are throwing off a lot of share buybacks. They have been historically doing a lot of share buybacks. They're going to continue to do share buybacks. And I think it was May time, they said that they are going to buy back 14 million of shares. And if you do look at the company's history, they have done a good job of buying back shares. You can see here, really, since 2019, the focus has been on buying back shares. And you can see they have bought back around about 15%, 20% of the market cap or the shares outstanding, which is pretty positive. If you said that they're buying back these sort of shares, this is a good sign. But unfortunately, the financials need to be a bit better. And sometimes there's a big deal made about share dilution and shares being bought back. And people think it's a game changer, like, oh, the shares had been diluted. And this comes down to when money came on the scene and they made it look like a big deal. Unfortunately, there's bigger issues in this. And even though this is great, it's not the end all and be all of the whole situation. It's good, but sometimes, I've seen other companies that people shout out going, why are they not buying back shares? And this is an example of Dropbox, for example, a company that has been buying back shares. And, you look at what that's done on the share price for the last 5 years, and it's kind of not really got them anywhere. So it's funny that sometimes you see a big issue made out of shares, share dilution or shares being bought back. Why are they not buying back shares? And you can see here, sometimes it just generally doesn't make much impact on the share price. So it is a positive, but unfortunately the positive hasn't really shown any signs of success in the last few years. And I think the big thing is because unfortunately, financially, they haven't been moving in the right direction, which is the bigger problem. Financially, it looks like the competition, as we see here, is catching up to them and the growth rates are slowing down. And the big thing that we need is profit growth and revenue growth. And when you've got slowing factors of that, it's not going to end well. And when it's factoring that it's slowing down this much. So that's a big issue on that point of view. Profitability wise, the profitability is moving down a little bit, and it is hard to forecast the profitability because the profit margins have not been consistent as well, which is also another thing to kind of price in what profit margins are going to do, because the profit margins have not been consistent for a while. Now, the counter argument is that potentially you could value this off free cash flow, which is something that you could do. And a few people on a free cash flow basis might say it looks quite cheap. But what I also don't like about the business is the financial health wise, and this was one thing that kind of pushed me over the edge to sell as well, is the deterioration of the balance sheet. It used to be a company that had a cracking balance sheet, no debt on there. They used to sit on decent amounts of cash, as you can see here. They were on 1.2 billion of cash. But at the moment, the cash pile has kind of stayed a little bit more stagnant. And debt-wise, they took on a big amount of debt. They took around about 1.3 billion of debt, which I was not a big fan of. 1.3 billion of debt is quite a lot to pay off. Now, at the moment, they are in a position where they could pay the debt off overnight and there'll be no cash remaining. But I thought this was quite a heavy debt balance that they took on, which I believe was because of the acquisition that they made, which, looking at the growth, hasn't translated into a successful acquisition as well, which also isn't great to see. So ultimately, what do I see the company valued at? What could be the upside? And where would I buy on Dropbox? And I think with Dropbox, I could buy, but because the growth is so low, it would have to be a very low valuation. And for that reason alone, that is my major worry. Like, if we were talking about a company that was growing faster, I think I'd be more open to buying it. But the growth is the big worry about it, and the competition catching up. Well, let's just say the company does grow at 2, 3, 4%. And we currently look at the profit margin of 10, 12, 14%, which, once again, I said earlier, the profit margin is really hard to factor in at the moment because we haven't had consistent profit margins. So that could be anywhere at the moment. I have factored a share buyback in as well, that they continue to buy shares in the next 5 years. And I have kept it a multiple of 20 times earnings. Now, you can see here that the upside is negative 30%, negative 13% and 5% on the high side, and on a share buyback point of view, it could get up to 20%, which for me is not worth the risk. For me to buy this, I would have to see this lower number near towards 100%. So that is a big issue. Ultimately, I think the big thing is that for me to come anywhere near to buy this, I think the share price would have to go in half. I think we'd have to see the stock fall to around about $12 to actually kind of come interesting. So if I just drop that back down to a 4 billion valuation now, or 4 billion market cap, you can see here the upside is a lot more attractive, which suggests this is way off for where I could buy. Like I said, I think ultimately the big thing is that the company needs to get back to growth. If this company went back to, let's say, 6% revenue growth, 6% revenue growth, 8% revenue growth, 10% revenue growth, and they were able to get more consistent profit margins, that is the bigger way where I think this company becomes investable. So I think they need to put more serious amounts of growth in. That's the ultimate thing. At the moment, with the numbers they're doing, I think that it's just way off for where I would be willing to buy at these sort of levels. And I think there's a lot better companies out there to be buying, especially with that competition aspect that's kind of coming in. So yeah, with Dropbox and its 23% drop, I'm happy that I took my profit where I did take it, and for me, the company is way off where I would be willing to buy, especially with the concerns around the competition at the moment and how they seem to be struggling for growth 100%. So yeah, that's where I'm at with Dropbox. Hope you enjoyed the video, guys. I'll see you in a bit.